Hey, good afternoon, everyone. It is 1:57. I'm sorry this is a little delayed from market close. This is actually the third time I've shot this video. We seem to be having some technical difficulties getting it converted out, and then it wipes it out and cleans it up. So, hey, third time's a charm, so we'll try to make this the best and most concise one. So let's talk about what's going on in the corn market first, because it's wild, right? 6 straight days of up, and my gosh, we're never going to go down again. So let's talk about that. What is happening? Well, it's dry in Iowa, it's dry in eastern Nebraska, it's dry in big parts of the country that are high production areas, and the forecast is pretty dry through kind of the first week or two of June. And so there's lots of worry that we're actually going to contract our balance sheet, not expand it. So let's keep things really, really simple, and let's just talk through this, right? If you have a contracting balance sheet, you are going to have higher prices. If you have an expanding balance sheet, you are going to have lower prices in general. So what would cause the balance sheet to contract or have a tighter stocks to use, a tighter carryout? Well, if we burn up Iowa, which is the largest corn producing region on earth, if we burn that up, we're going to have higher prices. So what does that mean from a national yield perspective? Well, the USDA is telling us that we have a 181.5 coming. Okay, if we drop that down to say 173, 170, 165, then our carryout will begin to shrink so long as the demand numbers stay where they are. Now, let's assume demand stays steady for now. If our yield drops to 165 or to 175 to 172, then we are back into last year's balance sheet ranges. If we start to creep below that and get down into the low 170s or high 160s, then we have a problem, because we've now actually contracted our balance sheet year on year. And so that would necessitate higher prices. Now, if we have that kind of a problem and we go sub $1 billion on our balance sheet and our stocks to use ratio gets down into that 5-6% level, then we have a 2012 type event, and we are going much, much, much higher. So I hope that puts it in perspective why we get the exuberance we're getting, because traders are looking for much, much higher prices. So why are we not freaked out about that, and why are we not rushing to buy the market and say, oh my gosh, lift all your hedges right now, own everything, re-own the last 7 years of crops, right? Well, let's think this through, and let's be careful about what our priorities are. Because from our seat, our number one priority is to defend your profitability and your balance sheet. And what we know for sure is that the USDA has printed a 2.2 billion bushel corn carryout, which would necessitate lower prices than where we are. So this is the July corn contract that I have in front of you. And I'm going to walk through this one in December, and you'll see what I'm talking about from where we're going to get bullish and where we think we might go. But first of all, this one has about 30 days left on it, so it's losing its importance every day that trades through it. But basically, the market is saying, hey, we need old bushels. But if what's actually happening with the spread is that the spread is actually contracting, which means the inverse is getting smaller as new crop rallies above it. To me, that's not bullish, because if we were really short corn and we had to ration, then this one's got to blow the top off of it, because you ration in the front, and that's always the case. You always ration up front, because you have to put a premium on bushels that are known, and you have to call them to market. And that's not how these spreads are behaving. So that's bearish factor number one. Number two is the fact that we have really not done any significant chart damage. Now, except for this, we did take this back out, and we did trade back up above here. So July corn did some heavy lifting from this perspective, and it does call into question whether or not we're going to roll over and come back down. Now, what we haven't done is we haven't had a sell-off and then a subsequent rally. That has not yet happened, and so you can't have an uptrend without a series of successive higher highs and higher lows, okay? That's why you say we want 5 waves up, 3 waves down, and then back up. That's because that's a series of higher highs, higher lows. It's also conducive to Elliott wave analysis, which is a whole different piece. But the foundational technical principle is you need sell-offs and rallies that take out the prior highs, okay? Now, of course, our biggest thing is this hedge line, which we're now above, We're now above some resistance, but we have not yet taken out our daily clouds, and we have not yet broken our uptrend line from back in here. You see how this is all working together to tell a story? It's not necessarily just one day and done. Hey, we got to buy it. We want to look at the bigger picture and realize exactly what is really at stake. So let's look at new crop corn. Okay, I've got this zoomed out a little bit and contracted so that you can see it from a bigger picture. So we have rallied. This is a Fibonacci resistance from the April breaking point where we broke lower, and we have rallied above the 50% mark, and we're challenging the 61.8%, but we have not broken it yet. We also have not yet broken this prior level of resistance, which is, if you remember, where we wanted to lift hedges before, and then we got whipsawed, right? And we put them right back on. And so there's a risk here that same thing happens. Now, right up above it, and let's look at this, and I wish I would have looked at this the first time in more detail, but hindsight's always 20/20. I wish I would have looked back and said, hey, you've got 543, this chart resistance back here. You've got this stuff right up in here. This looks like really, really choppy water to trade through this entire range. It's overlapping, it's corrective, and if you chop back up into it, that's going to be hard to navigate. You're better off waiting till you get above it to initiate a long position, because then the coast is more clear. Okay? Now, we're not going to wait quite that long, because we're going to watch this daily cloud. Bottom line, if we get above 550, then we're going to want to start to defend something up higher. And the reality is, most of you are hedged from up in this territory, and so we're not concerned about this action up. Remember, as a farmer, you are never losing money if the price of corn is going higher, unless you've just sold everything way too cheap and you have no upside potential. But in this situation, we're not upside down. We're still working from ahead. We have lots of opportunity to re-own these bushels and capture not only some of our hedge money, but open up our upside. And the last reason I'm not worried about it is because if it's true, let's run with this for a second. If it's true that we're going to burn Iowa up, right? Iowa's yield drags the whole national yield down to 160. From 181.5, we're going to drop it down to 160 on, call it 90 million acres, right? That's a lot of bushels. So if we drop 20 bushel an acre off of a 90 million acre crop, you can do the math, right? That's a lot of bushels out of supply. That's a super tight carryout. That's probably tighter than 2012. Where do we go if that's the case? Well, we're not going to 650. We're not going to 750. We're probably going to 9. We're going to go blow through the 2022 highs, the 21 highs, and the 2020 highs. We'll probably go blow through the 2012 highs as well, if that's the case, because it's simply too tight. The market needs to go ration corn. So when we're looking at risk management and managing your balance sheet risk, that upside is awesome, fantastic. I hope it happens. But what I'm worried about is this congestion area right in here, and this cloud holding, and this thing coming back down and it raining in Iowa, and now all of a sudden we're talking a 182, 3, 4, or 5 yield, and our balance sheet's not 2.2 billion, it's 3.2 billion, because demand got stinky too, and now all of a sudden we're not trading $4, we're trading $3.50 or $3.20. And that's what this could turn into here if all of this resistance holds. So we're going to be very, very slow to come out of these hedges and reopen and expose you to downside risk, because we're going to have lots of opportunity, and if we do trade much higher, then we could go much, much higher, but we have lots of time and room to do that. All right, I'm not going to belabor that point anymore. I hope that makes sense to you. I hope you can appreciate our concern is down here, not up here, because there's lots of fun days ahead if we're trading up in these areas, okay? Now, let's look at soybeans. Soybeans wanted absolutely nothing to do with the rally except for today, right? This is old crop beans. We've done nothing to generate any type of action here. It looks to me like we may get a small little relief rally if corn goes higher, but then likely it'll get sold. If not, we could just reverse from here and come on lower. Lots of chart resistance that it's got to get through in order to come up, right? So beans, we're looking lower, and to me that makes corn bearish as well. New crop beans had a more bullish day because they did have a bullish engulfing day. We took out 2 prior closes, and this looks like it could actually work a little bit higher. But given the fact that it really didn't want anything to do with corn's rally, makes me really skeptical of the strength of corn's move. Because let's face it, you're not going to kill the corn crop in Iowa to the tune of 20 bushel, 30 bushel an acre and not hurt the bean crop. That makes no sense whatsoever, because unless these algorithms are just so perfect, they can call the day to the rain. It's nonsense. They don't know the future any better than you and I do, and they certainly don't control the weather patterns. So from a bean perspective, I think this looks really weak. It's done no chart damage at all. I see no reason to change that until we seek higher prices or get some sort of bullish catalyst that we haven't been able to pay attention to. All right, last thing that I think is more bearish than bullish is Kansas City wheat. You know, Kansas City wheat has been unable to withstand to put on any type of significant rally. We've had big wide ranges. We keep challenging the lower end of these ranges, and we're below our cloud. So we're going to continue to look lower in Kansas City wheat. I don't see any reason to look higher, and until we get back above some of these levels. Now, same thing as corn, right? If I pull this back, and we do, let's say we did rally back up, well, now we're back in the same situation as corn where we have nothing but choppy overhead resistance that's going to be hard to get through. So that really clouds the bullish case. So if something, what would it take? Let's ask this question. What would it take to propel something so high that it chews through all of this chart resistance? Well, it would take something like we're going to burn up Iowa in the corn crop. I mean, that's what it would take. So, or something horrible that disrupts global supply, and we have to come by the Kansas City market, right? So if that happens, then we have lots of opportunities to step into re-ownership. There's not a huge reason to be in a hurry to buy this market because we've got lots of time. All right, I feel like I beat that horse to death. I think even speculatively, I don't see any reason to be chasing this to the buy side. You know, if long calls, short futures is kind of where we want to be and where we're at, and we'll just be watching it and trying to trade from the levels that we've already talked about from a spec standpoint as well. I do expect lots of volatility, which is going to be awesome and create lots of opportunity for us to improve positions and create value. So we thank you for that opportunity, and we do wish you a very safe and restful weekend. Remember, there is always risk trading commodity futures and options, and you should only do so in light of your own financial condition. Hope you guys have a great day. We'll talk to you later.